Hello and welcome to a monthly recap. This is for the month ending today, April 2025. I hope you all had a wonderful April. May is right around the corner. I love May. It's my favorite month. It's just so pretty. Rain and snow and summer is right around the corner. I just love it all. So, hope you all had a wonderful month. Hope you all have a wonderful month ahead of you. So let's talk about April. Okay. April was a really busy month, as you all know by now, right? We're living in it. But I want to talk about GDP. We actually got the first quarter reading of GDP quite literally today. So I'll talk about that. I'm going to spend some time talking about the R word, recession. Are we in one potentially? Who decides if we're in one? What does a recession actually entail? How does real estate perform during recessions? Talk about all of that. Jobs. Really, really fascinating stuff going on in the labor market right now. Talk about that. Inflation had a good month. Great news for all of us. Is it going to get worse with tariffs? Talk about that briefly as well. I want to talk about the administration and the Fed. Okay, right now they are kind of duking it out a little bit. And I want to talk about a history lesson on that front, as well as what kind of we expect. There's two big Fed meetings ahead, one on May 7th and another one in June. So when does the Fed cut rates? Are they going to cut rates? And then real quick on mortgage rates. Mortgage rates did tick up slightly on the month, okay, about 1/8% worse compared to this time last month. Now, that's for like the first time home buyer making less than 120% area median income, kind of one of those ideal scenarios, but rates are right around 6.75% today. So let's get into it. Let's start with GDP. Okay, so GDP is the most common gauge of how an economy is performing. Okay, it's the overall economic health of an economy. It's a way to compare your own economy over time. Quarterly is how they do that, as well as comparing it to other countries as well. So the most common definition of a recession is 2 quarters of consecutive negative GDP. So contraction. Okay, so contracting economy, 2 consecutive quarters of that. Now, I say the most common because that's actually not what decides whether or not we are in a recession. We actually had 2 negative quarters of GDP, I believe, in 2022, and there was technically no recession. Okay, so who actually decides whether or not we have a recession or not? That actually comes down to the NBER, okay, the National Bureau of Economic Research. They are a private company, private U.S. company that does a lot of research on economy. They have a whole lot of Nobel Prize winners over time because of all the economic research that they do. And they are the actual ones that dictate and decide whether or not we are in a recession. Kind of crazy that it comes down to the NBER to decide that. But that's the case. So when we had 2 negative quarters of GDP, I think, again, it was in 2022, they actually didn't call a recession. They said, hey, this didn't quite meet the definition of a recession. Now, what is their definition of a recession? It's right here. A significant decline in economic activity spread across the economy lasting more than a few months, so a couple quarters would certainly satisfy that, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Last time when we saw 2 negative quarters of GDP, they actually came out and said, hey, it wasn't spread across the entire economy. Okay, this was limited to certain sectors. It didn't really impact the entire economy as a whole, and that's why they didn't actually call a recession. When all the market experts are like, hey, 2 negative quarters should be a recession, they actually didn't call it that. Okay, but traditionally, it's a very good indicator. Okay, if there's 2 negative quarters of GDP, they're likely going to call it, even if they don't do it 100% of the time. Now, this is all really, really relevant because when we got the reading on GDP quite literally today for the first quarter, it came in at negative 0.3%. So contracted 0.3%, negative 0.3%. So it's kind of fascinating. They don't call a recession until it's in the rearview mirror, right? So we could have a conversation in July, and they could be like, oh yeah, back in March and April, you were technically in a recession and you didn't realize it. That's entirely possible. We could technically be in a recession right now, and nobody has officially called it one because they don't call it until after the fact, right? I talk to people all the time. They're like, hey, when should I lock in an interest rate? I'm like, great. Let me look at history. Oh, you should have locked it in on this day back here. That's the day that you should have locked. We only know looking in the rearview mirror when you should have bought. When is housing prices going to peak? When is interest rates going to, hit their low point? But we only know when we look back at history, we can point to the specific day, like that one day at that 1 hour. That's when you should have done it, right? Same thing with a recession. They look backwards and say, hey, you were in a recession. We could very well be in one right now and not even know it, okay? Now, history would also tell us that during recessions, real estate actually performs very well. It's a stable, tangible investment. When real estate is not the virus that's causing the recession, like 2008, real estate actually performs very well during recessions. mortgage rates come down during recessions and home prices go up during recessions historically. Now, what's also interesting is with all this tariff talk that's going on, a lot of spending got moved up. It's a little bit of an exaggeration, but a good comparison would be if you're living in Florida, which I lived in Florida for a year. Whenever there was, hey, a hurricane is coming, people would hit those grocery stores hard, right? They would, they would all stock up. They would all grab everything they could, Pop-Tarts and Top Ramen, and they raid the grocery stores. All that spending got moved up. Okay, that's something that they would have bought later, but they moved it up in advance of the hurricane. Same thing with tariffs happened. We saw a lot of people going out, especially with like luxury purchases. Luxury is the wrong word, but high-end purchases like vehicles. A lot of people moved up their time frame on buying vehicles because they were worried about tariffs down the line. That's really, really interesting because that could make the next quarter GDP look even softer since people moved up those purchases. However, it actually might not. And the reason it could not have that effect potentially is because companies did the same thing. They stocked up, they were buying a whole lot of goods, and then they're going to be selling those goods over time. So it's entirely possible, they didn't see the profit when they stockpiled. They're going to see the profit when they actually go to sell. So yes, that could negatively impact GDP going forward. It could actually also slightly improve GDP going forward. They might have stockpiled a lot of stuff and now they're selling it, and they could actually make their profits look better next quarter. So who knows? Time will tell there. It's going to be really interesting to see, though. A lot of people did move up some big purchases in advance of tariffs hitting them. So that's GDP. We could very well be in a recession right now. We might not even know it. We might not even know it until, July, August, when they might officially call one. So going to be interesting to see what happens there. Let's talk about jobs. Jobs are really, really interesting right now. Okay, so let's start with job openings and labor turnover survey. This showed that there was 7.192 million jobs available in March. Okay, that was well below expectations. Okay, well below expectations. It's also down from 12 million after the COVID peak. I'm not going to spend too much time talking about JOLTS only because it can be a little bit misleading. It's entirely possible a company has one job to fill, but they've posted that job in 10 different states because it's a remote workforce position, right? So these numbers are probably not going to be very reliable, especially in this post-COVID hybrid workforce environment. It's entirely likely that those numbers are, kind of skewed and probably not very accurate. But regardless, the job openings have been coming down. Okay, set that aside real fast. Let's talk about Bureau of Labor Statistics, okay, the government's employment numbers. For March, the jobs report showed 228,000 job gains when there was only expectations of 135,000 job gains. That's a huge number. That they blew the expectations out of the water. That's the headline number, blew the expectations out of the water. Really strong jobs numbers, which is interesting because when you look at some of the underlying data, it didn't look nearly as strong. The prior two reports were revised down by 48,000 jobs. That doesn't look great. The unemployment rate actually increased from 4.1 to 4.2%. That also doesn't look great. Turn the page on BLS. Let's talk about ADP. So we actually got two ADP employment reports just because of the timing. We got literally the April jobs report today for April. So in March, it showed 155,000 job gains. Expectations were only for 105,000 to 120,000. Yeah, once again, it blew expectations out of the water. Today's jobs report was much softer. That only showed 62,000 jobs being created when expectations were for 115. So a little bit of a mixed bag. March's numbers were good. April's numbers were not so good. But I want to spend most of my time talking about real fast the underlying data, okay? Because we get these headlines of, hey, look, March jobs reports are better. Woohoo! But the underlying data is really kind of the part that has me a little bit concerned. So those quitting their jobs came in at a paltry, very low, anemic 2%. Why is that important? Well, people feel more confident quitting their jobs if there's a lot of jobs out there, right? When only 2% of the jobs market is quitting their jobs, that means they don't feel great about their opportunities that are out there. Okay, the grass is greener on the other side. Heck with that. I'm staying put. I'm going to stay in my house because I know I have a job. I've got a paycheck. I'm going to stay put. It's not a great time to go and look for a new job if you don't have to, right? Job changers. So those who have changed their jobs, they've seen their income increase 6.5% year over year. That's down from 6.8%. So that's one piece that's a little bit great. You don't like to see a moderation in income when you are changing jobs. You want to see, hey, they're paying you king's ransom to switch jobs. We need that talent. We need to bring you over here. They're throwing money at you left and right. Well, we're not really seeing that. That decreased from 6.8 to 6.5%. Those staying on their jobs have seen their income increase 4.6% year over year. That's down from 4.7. So again, we continue to see this moderation. 6.8 down to 6.5, 4.7 down to 4.6. But here's the more important piece of all of this, okay? The spread between those who've changed their jobs and those who have stayed on their jobs is the lowest on record. What that tells you is employers out there are not having to throw a lot of money at people to incentivize them to come. They're not hiring, or they just don't have to pay that much money to get them because there's enough people looking for work. So again, some of these numbers aren't terrible, but it is a little bit of a pause for alarm, right? It's maybe not a red flag, but maybe the yellow flag. Okay, maybe it's orange. There's just some underlying pieces that say, hey, like the jobs market is probably not as strong as the headlines would lead you to expect. Okay, and that's really what I was trying to convey. Let's talk about inflation. Inflation had a really good month. It's going to have another good month next month because it's going to get harder to make some meaningful progress on inflation going forward. But some of these numbers are bonkers crazy, right? So I apologize for all the red in this slide because there's lots of green in this one. All right. So producer price index, wholesale inflation as businesses felt it. The headline figure went from 3.2 down to 2.7%. That's a huge improvement. It's also the second great number we've had in a row. Okay. The core rate went from 3.4 down to 3.3%. We'd like to see inflation going down. Core rate is when you remove volatile food and energy from the equation. How's inflation improving? So wholesale inflation, businesses inflation, great, awesome, super strong numbers. Consumer price index, inflation as us, consumers feel it. Okay. Negative 0.1% in March. The headline went from 2.8 down to 2.4. Huge improvement again. And significant improvement, second great number again in a row. Core went from 3.1 down to 2.8. Huge improvement there. Awesome. Core consumer price index is one of the two top numbers that the Fed looks at when they look at, hey, how are we making progress on inflation? So nice to see the core rate went from 3.1 to down to 2.8%. And then personal consumption expenditures. This is the Fed's favorite measure of inflation. Okay. Also, inflation as we feel it is just on a different kind of analytical scale. So personal consumption expenditures headline was 0. The core was also at 0. We got those numbers quite literally today as well. Headline decreased from 2.69 down to 2.29. Huge number, huge improvement. Love it. Awesome. The core went from 2.96 to 2.65. Also, strong improvement. Love to see it. So good news on inflation. Again, the headlines on the jobs market is also pretty strong, but when you look at some of the underlying data, there's more to be concerned about there. Inflation made some strong, meaningful progress. Love to see it. It's great news. All right. So let's talk about the Fed and the administration currently. Okay. This is getting a lot of headlines. So the administration, okay, is rather upset with the Fed. They want the Fed to start cutting rates now. They don't want them to wait. They want them to do it now. If it was up to them, they would have them call an emergency meeting like they did after COVID-19 and immediately start to slash rates. Okay. The administration says, hey, inflation is not a problem anymore. We need to start cutting the Fed funds rate. Now, why would the administration want that? Well, the biggest reason is if they want to enact all these tariffs, right, it's basically a tax. It's going to cause price of goods to increase. You're going to be paying more money for goods. One way to combat that is to lower the Fed funds rate because that's going to directly impact your personal loan rates, your credit card rates, your home equity line of credit rates. Great. So they can mitigate some of the effect of tariffs by having the Fed cut rates because it would basically reduce the effective cost of goods by having you pay less interest on those goods. Okay. So the administration obviously has a dog in the fight. They really want the Fed to start cutting rates and get aggressive with it so that their impact of tariffs will be somewhat mitigated. Okay. Now, the Fed's position is, look, inflation is stubborn. Yeah, we saw some progress on it, but it's still stubborn. It's still, they want to see the core PCE number get down to 2.0%. It's 2.65, so it's still well above that target. And the Fed also knows it's probably going to get worse before it starts to get better. Okay, so the Fed's position is, hey, inflation is still rather stubborn and jobs are resilient. You see the headline numbers, jobs are still resilient. Okay, it's also worth noting, and this is the history lesson here, that the Fed has operational independence ever since the Treasury-Fed Accord of 1951. Now, what happened back in 1951? They were getting a lot of pressure. The Fed was getting a lot of pressure from new presidents, from new administrations saying, hey, you got to do it this way, this way, this way, this way. And the Fed said, look, we can't keep bending ourselves to the will of whoever's president. Okay, we're supposed to be independent. We're supposed to, be able to operate on our own terms, look at the underlying data, and not overreact to who's in charge. Okay, so they actually had an accord back in 1951 after they were receiving some pretty strong pressure from the president at the time, and they said, "Look, we need to make sure that we are independent. Okay, are we an arm of the electoral or not? We need to get some very clear, distinct guidelines in place so that we know that we are indeed independent. Um, and they did that back in 1951. So it's actually historically pretty common for presidents to pressure the Fed. There's pros and cons to this. Okay, there's pros and cons to this. I would say there's far more pros to having operational independence than cons. The cons are, though, that, hey, it's really hard for a president to enact their agenda if the Fed is not cooperating. Okay, if they're trying to raise money and capital and raise taxes and all this, and the Fed is not playing along with them and helping them along, it can make it very hard for them to enact changes. That's the con, right? The pro is, if it was every president in charge, all they would want to do is have the Fed keep rates at zero, so then they keep the economy running along. That leads to inflation. And when you look at the countries that don't have this central bank have operational independence, they have rampant inflation. It's not always the case, but very common the case. Rampant inflation, dollars worth nothing. It has a huge impact on the economy. So definitely more pros than cons. I think most experts would agree on that as well. But yes, right now the Fed and the administration are fighting with one another here. Jerome Powell is in the blue corner. President Trump is in the red corner. All things being equal, though, the Fed would prefer to cut rates in June, not May. Why is that the case? Well, here's our 2025 meetings. The meetings that are in bold with an asterisk are meetings associated with the summary of economic projection. Okay, which is where the Fed comes out with their dot plot, right? They don't just make a decision on rates, but they actually show where they think things are going from here as well. Okay, so in May, it is not one of those meetings. It is an abbreviated meeting. It is not a meeting associated with a summary of economic projections. The Fed would prefer to cut rates in June so that they can show their work. Okay, so that they can show, hey, here's what we did today, and here's where we think things are going with regards to unemployment, with regards to inflation, with regards to GDP, all of that. They actually have to show their work and put pen to paper. Okay, they would prefer to cut rates in June, not in May. The administration wants them to cut rates right now, ahora, pronto. So expect this fight to continue. It's going to get worse before it gets better. The Fed doesn't want to cut rates in May. Will they be forced to cut rates in May? We got negative GDP. We got inflation that actually looks pretty solid, at least on the headline figures. We have jobs market that had a pretty, month in April. So maybe the Fed does feel empowered to start cutting rates. We shall see. If the Fed does not cut rates in May, expect to hear a lot of headlines about this, okay? The new administration is going to roll up their sleeves again, get right back into that ring and start throwing haymakers because they are quite upset. The administration went as far as to say, we might think about removing Jerome Powell as Fed chair. Quickly, lawyers and his own economists stepped in and said, look, this would be terrible. Don't do that. It would cause the stock market to collapse because you can't remove them. It would become a legal battle as to whether or not you're even allowed to do that. So they kind of walked that back pretty quickly once they talked about the ramifications of it. But expect that fight to get much, much worse if the Fed does not cut rates in May. All right, so let's look at May. May 7th, big Fed meeting. Does the Fed cut rates or do they wait until June when they prefer to cut rates? It's going to be very interesting to see. After next month, so we got one more month of replacing, somewhat, mild numbers of inflation. And then we're going to be looking at replacing some very, very cool numbers from a year ago. It's going to be very hard to make up ground on inflation after next month. Okay, so cross our fingers for another good month in inflation progress because it's going to get very hard to make progress after that. And then jobs. How's the labor market holding up? It's going to be really interesting after the Doge cuts, after, all these companies have been lowering their guidance as far as how much we're going to be able to produce and make earnings guidance. It's going to be very interesting to see when people start to actually cut jobs as well. And then what's going to happen with tariffs? I mean, every single day it seems to be something new. Tariffs are in place, then it's a 90-day waiting period, and then, hey, we're going to carve out exceptions for autos. It's just all over the map. It's going to be very interesting to see what happens with tariffs. So yeah, strap in for another crazy busy May. I think that's it. Thank you all so much for all the continued support. Thanks for taking the time to watch. I appreciate you all so much. Your referrals mean the world to me and my team, quite literally the world. A lot of lenders have gone through, reductions in force and that kind of thing, but I've kept my team intact because of you and your referrals. So thank you all so very, very much. I really, really appreciate you all. And have a wonderful day. Have a wonderful month. Appreciate it. Thanks. Bye.